Hey, what's going on? This is Kyle at Projection Hub, and today we're going to be talking about how to get an SBA loan for a daycare. So whether that's maybe a startup daycare that's brand new, or maybe you're an established daycare and you're looking to expand or open up a new location or get some new equipment in the daycare, this video is meant for you. So if you're watching this video, that means you've probably at least heard of what an SBA loan is. But it can get a little complex. People aren't, sure of exactly what it is or how to get one or how to be prepared to get one. And so today in this video, I'm going to be trying to cover the whole spectrum of the process from, what type of SBA loans there are, where to get an SBA loan, what documents do you need, how to increase your approval chances, lots of details like that. And so I'm going to be, walking through all of that. Because it's several different things, in this video, for example, I'm not going to demonstrate how to write a business plan. I will show you a resource on how to do your business plan, but this will already be a long video. And so I'll direct you to different resources and different videos that are deeper dives on any specific one of these topics. And so before I hop into it, why am I qualified or, to be talking about this today? So before my time with Projection Hub, I was an SBA loan officer for almost 7 years. And so during my time doing that, I would help businesses and startups prepare their loan application for their SBA loan requests. So that looked like reviewing their business plan, reviewing their projections, reviewing their financial statements, and helping them collect all of the items and answer their questions. And during my time doing that, I got a chance to work with actually many different daycares. That was probably one of the more common applicants we had during the process. And so have some experience on the SBA front doing that. And then Projection Hub, we've helped more than 50,000 small businesses create financial projections specifically, for their loan application requests or fundraising requests or all their different purposes. And financial projections are a very big component of a loan application, especially a startup loan application. So we'll talk about that a little bit more today too. So if at any point you have any questions about, what I talk about here today or about your SBA loan application journey specifically, contact us at support@projectionhub.com. Leave a question down in the comments below. We'd be happy to help. And if at any point during this video you like what you're hearing, give us a thumbs up on the video. That's super helpful for us as a fellow small business. So without further ado, let's go ahead and jump in. All right, so we are going to be using this SBA loan application checklist document to kind of help guide us through our conversation here today. You can get this checklist down in the description. I don't know if it's popping up anywhere in this video, but you can download this for free. I would encourage you to do that simply because you can even see here quickly, lots of links here to lists, free tools, not free tools, video guides, all different types of things that can be resources for you as you're kind of, depending upon where you're at in your SBA loan application process and journey and what you need help with. So reference this video, but you won't be able to click obviously on the video for everything. We'll try to link as much as we can down in the description of the video, but I encourage you to grab this free resource here to follow along with. And this is going to guide us through. So there's some things I'll talk about and show you that aren't listed on here, but I've got tabs open for those so we can talk about them. And first off, let's talk a little bit more about the types of SBA loans. So SBA stands for Small Business Administration. So that's a federal bureau or federal agency, however you want to call that, of the U.S. federal government, and they use a portion of taxpayer money to guarantee loans and back loans that are made to U.S. citizens and U.S. residents. And so when you're applying for an SBA loan, you're not talking to the SBA, you're not talking to the federal government. You are talking with what's called a loan intermediary. So those are banks, those are some nonprofits, those are different organizations that are facilitating SBA loan programs. And so there are different type of lenders that offer different types of loans. And I'm going to talk a little bit about those today and which type of loans are more common for types of industries and business stage and that kind of stuff. But just that's a quick clarifier, very fast way to explain that. And initially, we've got 3 different types of loans we've listed here. There are many different types of SBA loans that are even outside of these 3, but these are probably the most common for small businesses. And we'll talk about this today. So like if you were in agriculture, then you'd be talking to the USDA. They're going to have their own programs. And so there's lots of, energy department. It probably has their own funding programs for energy projects. And so this is going to be more small business, Main Street type businesses, traditional small businesses. So first off, we have microloans. These are probably I don't want to say the least well known out of these three, because most people just lump all SBA loans together. But I think these are probably the most underrated SBA loans. So there are SBA microlenders, and certified microlenders are offering SBA microloans for $50,000 and less. And so the lender I came from, we were an SBA microlender. We were also a 7A lender, and we'll talk a little bit more about that. But I think these microloans are really great for startup small businesses. Now, especially in the lens we're going to be talking about today for a daycare, I think microloans are an amazing resource because, there are some really big daycare facilities, and they're more like schools, and those are probably cost several $100,000, maybe millions of dollars to build those and whatnot. Microloans are not the right choice in that frame. But if you're an in-home daycare, or maybe you're starting really small, or maybe you are an existing one and you're adding on just in like an additional classroom or something like that, the microloans can be really viable. The reason I love microloans is because they are more flexible than like a bank would be or a traditional SBA loan process would be. They are less complex, they're faster, they're probably less strict in the underwriting process, and a lot of times they are lenders who are nonprofits that serve just a few counties or maybe part of the state or just a state rather than like a national type of lending entity. But again, they can be used for most purposes. For startups and existing businesses, the dollar amounts are just smaller. 7A is the most common SBA loan. The most known and common SBA lender or intermediary for facilitating 7A loans is going to be a bank. So if a bank chooses to participate in offering SBA loans, they're going to offer a 7A loan. 7A loans can go up to $5 million. There's a subset of this program called the Community Advantage lenders, which can go up to $350,000. And so a lot of these micro lenders also might offer that Community Advantage program. The lender I worked at in Indiana, that's what we did. We offered those two programs, so up to $50,000 or up to $50,000 or up to $350,000. I would say the 7A program is probably more for an existing business than it is a startup business, especially if it's a higher dollar amount. But that's just lending in general. It's a little bit more difficult for a startup to get a loan than an existing business, but that's just to keep that in mind. And then 504 is probably not the most common for a daycare unless it's like a really big facility. Then that might be an option. A lot of times these are going to be specific to larger construction projects or like manufacturing equipment or something like that. And they take on a unique lending structure because there's a CDC lender, and then there's a bank lender, and then there's a personal investment, and it's a little bit more complex, but the advantage is longer terms, lower rates, but there's just a lot more specific on what businesses can participate in that. So those are the types of loans. And so for a daycare, let's think about this between microloans and 7A as we're going through this, both startups and existing businesses. And the next step to this might be, looking at this checklist is where to find those SBA lenders. And we're gonna skip that for a second. We're gonna put a pin in that. We'll come back to the SBA, how to find an SBA lender towards the end, because you might be at the point where like, okay, well, I'm interested in a microloan, but how do I even prepare to apply for one? So let's talk about that first. The first thing I'll mention that is not listed on this checklist is going to be eligibility requirements. So the SBA does have restrictions to who can qualify for an SBA loan. Now, typically these restrictions are going to apply to specific types of industries or business models. For example, a life insurance company can't get an SBA loan, a pyramid scheme, a sin business, or gambling or an illegal activity or a speculative businesses, not a ton of surprising things as to what you can't use an SBA loan for. So that's probably not what's going to disqualify your daycare for being able to apply for an SBA loan. There is a list of personal eligibility things. So those could be like if you have a criminal record. Now that doesn't necessarily disqualify you. There are some nuances to that can disqualify you, but it probably looks more like just disclosing information and making sure your lender's aware of those details. There are specific things you could use SBA funds for and specific things you can't. So We're not going to go into great detail on this because you're probably not going to run up against it, but that's a thing just to be aware of when you're talking to your SBA lender. All right, let's talk about a typical SBA loan process. Now, this is going to depend, on what type of SBA loan you're applying for and what lender you're working with. Everyone's process is going to be a little bit different. If you're applying for a 7A loan through a bank, those processes are probably going to be the most similar to each other because it's a little bit more structured and regulated. If you're going the microloan route, that could look very different from lender to lender. But so these are kind of general steps. All of them are going to start with a lender intake application. Probably you can just go to their website and fill it out. You can, if it's a bank or someone like that, you could probably contact them first. They're going to take information like just about who you are and contact information and details about your business and all of that, what you're interested in and that kind of stuff. During that process, they might allow you to attach or upload documents. We'll talk about the documents here in just a second. But after that intake application, you'll likely have a conversation with a loan officer. I would want to speak to a loan officer if I was the applicant. If they aren't going to talk to you on the phone, that would probably be a red flag for me. There's a lot of things I'm perfectly content handling outside of the phone, but if I was trying to get a loan and I wanted someone to understand my business and the details of my business, I'd want to speak with someone on the phone. You'll go through all the details about your business. If it's a startup, key details about your plan for your business, your personal financial situation, that kind of information. You'll submit your documentation, which again, we'll get into that here in a second. And then once they kind of have all of that information about you, they will send that to underwriting. Someone's going to go through your documentation under a microscope, and they're going to try to poke holes in it. They're going to try to find all of the points of risk is their job. And so they want to make sure they're mitigating their risk, reducing their risk by getting answers to the most concerning questions and making sure they understand every aspect of your business and your personal kind of financial side of that. Once underwriting, they might go back and forth and ask questions or request additional documents. They will likely undergo some sort of internal committee or review where they will actually make a decision on whether to move forward or not move forward with your loan request. The lender I worked at, if we were doing a microloan, if it was approved in loan committee, then we would move forward with closing the loan, and that could happen pretty quickly. If it was one of those 7A loans, so up to the $350,000 or up to $5 million at a bank, if it was approved in a committee, it would have to go through some additional steps of SBA form completion. And this is kind of getting into the weeds, but different SBA lenders can have different authority. So some might have what's called delegated authority, which means the SBA has given them permission to approve their own SBA loans. So those can move a little bit quicker. They just need to collect different documentation and build that package. Some lenders don't have delegated authority, which means they have to take that package, fill out SBA forms, and then send it off to the SBA for review, which just means it takes more time. So that can change things. And then once all the final approvals are made, you'll do closing, sign all the documentation, and then be wired the funds pretty quickly after that. In regards to the length of the process, again, that's going to totally depend on the type of loan and the lender. Microloans, I would say probably in the 2 to 4 week time frame, 2 to 6 week time frame. But just ask your lender. Some microlenders have express loan products that can turn around really quickly, but maybe for a smaller dollar amount. Larger loans or 7A loans, you're probably looking more 4 to 8 weeks, 4 to 10 weeks. It's going to be more of a process. So just communicate with your lender and ask what your expectations should be on that front. And do everything you can to be prepared so that that's not holding up the process. So we've talked about the typical process. Let's get into the documents. This is kind of the meat of the application process and a very key component of that. So let's start with startups for a startup daycare. Then we'll talk about an existing daycare, and then maybe if you're acquiring a daycare. If you're a startup daycare, you're going to have your lender application, which we've already talked about. Every lender will probably have their own lender application. So there's not a generic one to fill out beforehand. Rather than just knowing all the numbers you can and the details you can about your business to be prepared for that application. A personal financial statement. Again, this is another example of every lender will have their own. I linked to the SBA's personal financial statement here because even if the bank won't accept your personal financial statement and they'll ask you to fill out another one, it's probably a good exercise to be familiar with that and to fill it out and to just feel like you know all of the information you need to in order to complete that. 2 to 3 years of personal tax returns. So have that located and ready to go. And then the two biggest things as a startup are going to be your business plan and your financial projections. And I think your financial projections are going to be the biggest component of that. And I'm not just saying that because I'm biased, but when I was a lender, for a startup daycare, like 80% of the decision was probably based on their financial projections. The other 15% was probably based off of 15 of their personal financials, probably even a bigger percentage than that. And then lastly, the business plan. So you'll notice they have links here. We have some resources to help with that. So we actually have a free daycare business plan template that, here it is actually, right here. We've got this filled out as a fictitious example. So the structure, you can fill it out with your own numbers and your own details. We've got a video that shows you exactly how to fill out or to create a business plan for a daycare. That video goes through key points on I think it's 5 key points on how to make your business plan as lender ready as possible and kind of walks through the sections of that. So I encourage you to get this free business plan template. That would be a very helpful guide for you. And then on the financial projection side, we also have a projection template. This one is not free. However, it's very affordable. And just to talk about this for a quick second, you have to have financial projections if you're a startup. And there's probably 3 ways you're going to have financial projections done. 1, you're going to pay an accountant to do that, which can be pretty expensive. 2, you do them yourself from scratch, which is going to be very difficult to do and probably pretty unreliable. There are free templates out there, but they're probably not going to be done to the level of detail you'd like them to be. And then 3rd, you can buy a good template, a qualified template, which is what I'm showing you here today. This was built by our CPA on our team. We offer free support, free reviews, and all you're doing is you're just putting in your information in these blue boxes. So you can see here, you're outlining, your plans for how many classrooms you plan to have and kids in the classrooms, just in these blue boxes, your monthly expenses that you plan to have, and then salaried employees, and, owner draws or owner payments. And then it's going to generate all of the charts and graphs and financial statements that you need and your lender needs for your business plan. And so I've linked that in the description below. There's also a link down there that you can fill out to get a discount on that. It's already less than $100. I promise you it's worth it. Again, free support and free reviews. But in addition to those 2 documents, you will have to do a credit release form. The lender will have that. You will have to go through a credit check for your application process. Now, different lenders will do that credit check at different times. So you might ask them, if you're talking to several lenders, then you probably don't want them all to do a credit check. So they will do what they can with your estimated credit score, or maybe you do your own credit check. But when we would do credit checks at my old lender, we would wait till later in the process to make sure we wanted to move forward with reviewing theirs, rather than if we knew pretty quickly it wasn't going to be a good fit, we would hold off on a credit check. So you may ask your lender when they plan to do that. A government issued ID. If you're doing a larger loan, you're going to have a resume. If they don't require a resume, you're at least going to have to talk about your experience, probably in your business plan. And then also additional SBA forms like we've already discussed. Now for an existing daycare, a little bit more documentation is going to be necessary. Again, lender application, you'll have to fill that out. Personal financial statement, personal tax returns. Now business tax returns, 2 to 3 years. If you file them as an LLC or a sole prop through your personal tax returns, then you'll probably have a Schedule C. You can include that. A year-to-date or current year profit and loss or income statement. Same thing for a balance sheet. This link right here goes to a free balance sheet template with a video on how to fill it out. And then financial projections only if the loan is going to be for expansion. So if you're maybe just looking for an SBA loan to refinance an old loan or pay off credit cards or, something of the nature that's not really expanding the business, it's just maybe optimizing some of your debt, then you're probably not going to need projections for that. But if you're trying to open a new location or add on to the building to have different classrooms or, add a kitchen or whatever, some sort of expansion, then you're going to probably need to include projections to demonstrate how that expansion is going to perform, and you're going to be able to pay for that. You can cash flow the loan, basically, the additional burden on the business that you're going to be able to handle it. This projection template I showed you is geared for startup daycares. We do have one specific to existing businesses that I'll link down in the description below, but this video links to that existing, how to create projections for an existing business. The main difference is that instead of building your projections from assumptions, like things you're assuming about the business, you'll actually put in some of your historical financial data and it will build the projections from that. So from like your revenue and your expenses from prior years. A business debt schedule and a credit release form, again, a government ID, formation articles. So like your business registration, your articles of organization, if you have any, you probably have relevant licenses and permits you need to operate as a daycare. You'll need to include those. And then again, additional SBA forms after lender approval. Now, if you're trying to acquire a daycare, an existing daycare, we're not going to talk about this a ton because this is a little less common that people would go the SBA route for that. But if you are, great, welcome. Happy to talk about it further. Here, it's kind of like all the documents from startup and all the documents from existing. You'll need to put those together and kind of produce everything because you're talking about a new business, but you're acquiring one that has historical performance. So your lender's going to want to know your plans, but also how the business performed before you're going to acquire it. Some key difference here, these yellow ones are listed. We actually offer a service to write the business plan and create the projections for you, which are available for existing businesses and startups, but more commonly, in an acquisition, that's something that people want to have the experts take care of that rather than doing it themselves. And we can also help with some due diligence if you're considering a deal. Okay, and lastly, on the document side of things, we've kind of got this catch-all of documents they may ask for, but are just going to be dependent on your loan scenario. So, for example, if you lease your building instead of buying it, then you're going to have to provide your lease agreement. If proof of insurance is probably going to apply to everyone, but these are things they might collect after the loan is closed, especially if you're a startup. If you're using a vehicle title, so maybe your daycare has a couple of buses, small buses for field trips and that kind of stuff. And, you're going to need the titles for those. So some different things that will be included, but I wouldn't be too worried about having all of these things in a row before you apply for your loan. Your loan officer will probably help you figure out these kind of additional documents. And then some additional ones like documentation of lawsuits or relevant judgments or prior bankruptcies and that kind of stuff. Okay, so we've talked about documents. Now let's kind of go back up and talk about finding an SBA lender, because there's, this is a kind of key component. I would say, half of the work is just making sure you've got a plan for your business and all of the documents and all that stuff ready to go. And then the other half is just finding a lender that's a good fit for you and that wants to move forward with your loan request. And so we talked about the types of SBA loans. Now let's discuss where can you get those loans at? Now let's talk about microlenders first. Kind of two buckets or two types of organizations I included here. One is called a CDFI, stands for Community Development Financial Institution. And then the other is SBA microlenders. Those kind of mutually exclusive. So you can be a CDFI and a microlender, or you can just be one of the other. They're two different certifications or two different types of programs because they receive different types of funding. Nonetheless, you can be both of them as two. The lender I worked for was a CDFI and an SBA lender and a 7A lender. So there's a lot of overlaps. But these are all linked to lists of places to find these types of lenders. And so, for example, let's look at the CDFI list, which is a CDFI locator. And let's say I want to go to a loan fund instead of a bank. And I want to look in California, and I am a micro enterprise. And I'm going to filter that. And so I can see what types of lenders are operating there. A couple of key points. Like you see, this one is in Oregon, even though I filtered for California. Some CDFIs cover multiple states. Some CDFIs might only cover a city or a few counties or a single state. So CDFIs and microlenders come in all different shapes and sizes. They specialize in different things. They offer different types of loan programs. And so I think microloans are a great route and CDFI microloans are a great route. You just have to do a little bit more homework. I think you might end up finding a much more complimentary lender. It just takes a little bit more effort. And the same thing with this SBA microloan list. You can filter by a state and you can see who offers those SBA loans. So SBA microloan, so this list is going to get you ones that offer that $50,000 SBA microloan. They might have additional programs, but they will have that $50,000 SBA microloan. The CDFI list, they may not necessarily offer the SBA microloan, but they will offer their own version of a microloan, if that makes sense. Okay, 7A is, we've got 2 resources listed here. And I've got in parentheses, if you want to find the lenders or if you want the lenders to find you. Most people would say like, oh, I want them to find me. So let me show you that one first. This is actually on the SBA website called Lender Match. You can put in your information, answer these questions, and then it will basically send out a blast to a bunch of different SBA lenders that the criteria kind of matches what you put in your application. And then they can opt in to basically contact you. I'm not saying you shouldn't do this. So when I was a lender, our lender participated in this program. So we would receive the requests and then we would reach out to the lender. And we didn't do a whole lot of them just because I think it's not as perfect in those matches. And it might end up just being a lot more work for you because you might have a bunch of lenders come in and say like, yes, we'd like to talk to you. And then they may not be the right fits. So if you're okay doing that legwork and you just want as many opportunities as you can, then I think that that's worth a shot. Whereas taking the ownership of seeking out the right lender might be a little bit more work up front, but you might not have to apply it 20 places. You might just need to apply it 1, 2, or 3. And so this is a tool we actually built using SBA loan data, I think for maybe the last 4 or 5 years. And so what we can do here is we can do some filters. So let's say California again, and let's do, there we go, child daycare services. And let's say they're startups. Let's do new business or less than 2 years in business. And so here we can see who's done the most startup loans to daycares in California, right? So it's not a ton of loans, but that's, again, just as a reminder, the 7A loans are not necessarily always going to be the best startup route. These are probably going to be more common for an existing business. So like, let's switch this to existing or more than 2 years. These numbers will probably go up quite a bit. So you can just see who's doing the most in this space, and that could be a good place to start. So if these filters kind of align with your scenario, you can see who's doing the most loans to that type of business, and that could be worth trying a conversation. SBA microlenders are not going to show up on this list, and they're probably doing a lot of work with startups, but again, just smaller dollars. So that's going to depend on how much financing you actually need. I would always recommend talking with your local bank or whoever you have the best banking relationship with as a starting point. Just keep in mind, they may not have an expertise in they may not have an expertise in daycare lending. Maybe they, only lend to existing businesses or, are really great at truck loans or whatever, because they have portfolio weights as well. So don't hold that against them if you've been depositing there for 20 years and they don't want to give you a loan for your new daycare. That I would start there because you have the best relationship there, but then use a tool like this to find ones that might be a good fit. And then 504 lenders, again, probably not the first place I would check for a daycare loan. But if it's a significant daycare, if we're talking a couple $1 million or something like that, 504 might be worth a shot if you want to get into that and research a little bit more. Okay, so we've covered types of loans, the process, the documents, where to find those loans. Now I want to talk a little bit more about, before I let you go, I want to give you some points on, recommendations to, I guess, improve your approval chances. These are not guarantees, but during my time as a lender and here now with Projection Hub and helping people prepare for their loan applications, we've learned some things on what can help your chances. And when I was a lender, what things we like to see or that I really like to see and gave me confidence when I was reviewing an application. So first off, be prepared. Have as much documentation ready to go as possible. Maybe that sounds obvious. The way I would do that is these types of documents here up top where I listed these out for documents for startups for existing acquisition, have those together. And that's a really great starting point. Don't worry about all the specific SBA forms, maybe not even as much about these auxiliary documents, but the PFS, the tax returns, the business plans, the financial projections, the financial statements, the ID, like that kind of stuff, have that ready to go. So when you talk to your loan officer, you can be like, yeah, I got it here. Like that's what they need to get the underwriting process started. A lot of these additional documents are what they're going to need to close the loan. So you're not holding up the process from moving forward. And that would be my recommendation. Number 2 is to have the right expectations. So we talked a little bit about timing earlier. So communicate with your lender and ask them what their timeline is. If you're not moving fast to get them what they need, don't have expectations that they're going to move you fast through the process. Some other expectations, you will be expected to personally guarantee the loan. Any owner over 20% will be expected to guarantee the loan. A lot of people think that they can keep the business and the personal separate. That's great advice when it comes to bank accounts and bookkeeping, but not realistic advice when it comes to getting a loan. You will be expected to sign, on that loan personally. So if the business can't repay the loan, they're expecting you to pay it back personally. So keep that in mind. Collateral will be expected. One caveat to that is kind of one of the main purposes of SBA is that the SBA is taking on some of the risk on behalf of the lender. And so the lender tends to get a little bit more comfortable if there's a collateral shortfall. However, they will request all available collateral. So that's only in the case that there is no collateral. But let's say, let's use, since we're talking about a daycare, daycares don't have a ton of collateral. You can't use toys as collateral. If you're buying the building or you own a building, that's your collateral. So that's great. If you're renting a space, which is probably more common for, a startup daycare, or maybe it's in your home, like you're not going to have that collateral necessarily from the business side of things. So there will be a shortfall. So they will ask what personal collateral you have. So that could be, do you have a free and clear car that you can put a lien on and pledge the car? A second mortgage on the house. Now, most lenders probably won't want to mess around with a second mortgage for, a $50,000 loan or a $20,000 loan. But if you're getting up there a couple $100,000 or even over $100,000, then that's a viable option for collateral. So just saying, expect that. If you know there's going to be a collateral shortfall, be prepared with what personal collateral you're willing to pledge and what you're not, and just know what you're willing to walk away from. Owner cash investment. So let's say you need $100,000 for your new daycare. The lender's not going to give you $100,000. They might give you $80,000 or $90,000, but you're going to have to come up with that difference on the project. Your deal will need to show sufficient cash flow based upon either historical financials if you're an existing daycare, or your projections if you're a new one. And what that means is the bank or the lender is typically looking at what's called debt service coverage ratio. And that is, they have different target numbers, but essentially they want to see, it's a calculation they're going to do, that by adding on the debt that you have to pay for, are you still able to generate sufficient cash flow for the business to continue operating or covering all of its obligations, plus covering the loan and repaying it without like a super narrow margin. And so the higher this number that they want to see, the more conservative they are, the lower it is, the more, risky they might be. So 1.25 is pretty typical, 1.15 for less conservative, maybe up to 1.35 for more conservative. But like our projection template will help you cover that, and just be mindful of like that the bank needs to keep that in mind. And then we already talked about business eligibility. So those are expectations, right? That's key point number 2. And we've already talked about number 3, right? Spend more time finding the right lender for you versus the most convenient lender. Your hometown bank may not be the right fit for you. I think it's worth having a conversation with them still, but just be mindful that your type of business may not be the right fit for them. And then also, if you're working with a loan brokers are great because they do a lot of legwork for you, but also loan brokers are getting a finder's fee from the lender that they helped you get approved for. So that might mean they don't always have your best interest at heart when it comes to getting you a lender. Maybe you're thinking, I don't care what lender it is, I just want to get money. That's fine. But you also have to keep in things in mind like interest rates and, your borrower experience, and like you're entering in a relationship with this lender. So you want to make sure that they're a good fit for you and going to be supportive of what you need. So just keep that in mind. Your loan broker is trying to get paid. They're not necessarily just trying to find the most perfect lender for you. 4, share the dirty details because they're going to come out eventually. So save yourself the time, the energy, and potentially embarrassment, okay? So what I mean by that is things like If you have a criminal history, share judgment documentation. If you're in the process of that, you need to share that information. If you have a not great credit score, talk about why that is and what you're doing to prepare that. If you are an existing business, if you have confusing financial or like line items on your financial statements, be transparent about where those are coming from. So just don't hide things like that, because if you go through and you get approved for the loan and then one of those things comes out later, that's not going to be good news for you. So be sharing those details, like if you had a previous bankruptcy and that kind of stuff. Next point is accurate financials and realistic projections. A very big red flag for lenders is if their first impression with your financial data is untrustworthy, they're gonna have a hard time coming back from that. So do the work necessary to either be really confident that your financial statements are accurate, whether that's working with an accountant or make sure that that's good to go. Or if your projections, that you've compared it to industry averages or had someone like Projection Hub review your projections so that your lender's not like, I'm confused by these. And then you're like, oh, sorry. And then you take them back and then you bring them back and the numbers are different. That just creates a little bit of uncertainty for the lender. For startups, ditch the long and generic business plan. Daycares, and I don't mean this to be rude, a daycare is not a novel concept. It's not a very complicated industry. Not that it's not important, it's very important. But you don't need a really long business plan to explain what your daycare does. Rather, you should have a short and sweet business plan that's jam-packed full of important, useful information. Things like, what are you doing differently? Things that you're doing really well. Your opportunity to succeed, your traction. So our free daycare business plan video will go into detail more on that, like what you should include in business plan and what you shouldn't and how to make it a lot better. So I encourage you to do that. Just 2 more points. Strengthen your application. More so, I mean personally for that. So for example, let's say you have a collateral shortfall. Like we talked about that already. You could add a cosigner to the application. Now, people don't love to do cosigners, but it's a really good option. And so I would encourage you, one, your cosigner needs to have outside income. They need to have income that's reliable and not attached to the business. And what I think you can do is, most people wait until they're asked if they have a cosigner to go find a cosigner. Do that in advance. So if that's a parent or a friend or a sibling or whoever, contact them in advance. Say, hey, I'm trying to open up a daycare. I'm going through the process of trying to secure financing. In the event that I'm required to have a cosigner, is that something you'd be open to? And try to nail that person down before you go into this process. You may not even need them, but it's a lot easier for when your lender says, like, is that a thing you might be comfortable with? You be like, yeah, actually, I already have somebody that would be willing to do it. Like, let me just double check that they're willing to move forward, and save a lot of time and some stress. Same thing with your personal collateral. Have that lined up, know what you're willing to pledge and what you're not. And then lastly, make sure that you as the owner or your leadership team or your startup team has ample and relevant experience. So your lender wants to know that you know what you're doing and you know what you're getting yourself into. So if you have all of the experience necessary to start and run a daycare and you've done it before and you've got all that, then talk about all that in your business plan and with your loan officer. If maybe you've never done this before, but you have some skills that are viable, you need to supplement your team, whether that is with an additional owner that has experience or a key employee or a manager, and then talk about that experience in your business plan and to your loan officer. So give them no reason to doubt that you don't know what you're doing. You're not, prepared to be successful. And there you have it. Those are my recommendations for improving your SBA loan application experience. This checklist is linked down in the description below. So go ahead and grab that for free. Go through and look at all the different resources. If you have any questions at all about your loan application and where to go and how to create a document and all that stuff, just contact us at support@projectionhub.com. Leave a comment on this video. We can answer you there as well. And grab your free business plan templates, grab your projection templates. There's a link in the description also to get a discount on our projection template. So go ahead and grab that too. And if you like this video, please give it a thumbs up. That really helps us as well. So I wish you the best of luck with your daycare and getting the financing you need. And we'll see you in the next one. Thanks.